Good morning, it's David Romanovski. I'm a Senior Financial Advisor at the Hopkins Group and a member of the Investment Committee that meets on a monthly basis to determine the position of our portfolios. I'm here together with Mark Wenzel,
Morning, David.
Also a member of the Investment Committee and a Senior Financial Advisor within the group. We'd like to actually highlight some decisions we made and discussed recently about portfolios going forward. Mark, can you give us an outline of the current portfolios and how they are positioned?
Yeah, sure. So I guess since the last video that we did, there's been some significant changes, I guess, in the market, David, which I think certainly highlights the need for us to, as an investment committee, to make some changes to the portfolio. So those primarily being that inflation expectations have risen significantly in the last couple of months. You've seen obviously US inflation, rise significantly, and also inflation here, and you're seeing that in regards to, lack of supply and difficulty getting all sorts of items, including food and other things. So you're seeing goods inflation, in the system. You're also seeing on the back of that interest rate rise are expected to be greater than what was forecast as little as 2 months ago, and certainly in the US they're forecasting significant interest rate increases, but also interest rate increases here. And then also there's the possibility of a stagflationary environment, which is characterised by low growth and a higher inflation environment, which is really difficult scenario to get out of. So the central banks are really cautious on those issues, which are potentially going to force them to increase the interest rates to quash the inflation faster, and that's obviously seen equity markets fall, and some equity markets particularly fall into that bear market territory, which is characterised by a 20% fall off all-time highs.
Correct. Mark, just wondering from your perspective, can you comment on the decision-making process undertaken by the investment committee to determine what we keep or what we change within the portfolios around the asset allocations?
Yeah, absolutely. So, obviously it's a robust discussion within the investment committee. We've got a lot of experience with the guys in the investment committee, particularly around investments, and typically we've been managing investors' money, in most cases, 15, 20 years. So, we're obviously all got our own views, but, it's a robust discussion within the investment committee, but once, the decision's made within that, it is a consensus type view that gets put forward. And on this occasion, we made some changes, and broadly, as the asset consultant described, the changes were likened to slowing a car from sort of 70 kilometres an hour to 60 kilometres an hour. So we're still, optimistic on the markets. We're still pretty bullish on the markets, but reducing the speed a little bit to acknowledge that there are greater risks within the markets and within the economy that could obviously significantly impact the portfolio has been an important change.
Absolutely. There's recently been a divergence away from growth stock to value stock. Can you actually discuss how we've actually considered that across the portfolios and what changes we've applied?
Yeah, absolutely.
And why?
Yeah, absolutely. So broadly the portfolio, the asset allocation, we've slightly reduced the Australian and international exposures within the portfolio and increased the exposure to infrastructure and to private equity. So we've done the move to infrastructure, which is equity-like. So you're going to get equity-like returns there, but we just felt that there was sort of a solid income coming from infrastructure assets. That infrastructure assets would benefit if inflation was to continue to increase over time, because a lot of their contracts are inflation plus type contracts. And with private equity, we've recommended an increase in that area due to the consistency of the returns and the regular, exposures within there. And you've seen, as we mentioned during the investment committee, that the Future Fund and Australian Super and the big superannuation funds obviously recognise the value of having private equity exposure in there for that sort of consistent, long-term returns that they deliver. So from that point of view, from the asset allocation changes have been those, and then also within the investment managers, again, sort of tapping the brakes, if you like, we've just pulled back a little bit from growth orientated managers to more neutral market style managers. So again, probably that are going to, in our view, are going to perform regardless of the market conditions. So, you know, that if there is that sort of higher inflation environment, having a more neutral stance will allow sort of the higher quality companies that we have in our portfolios and the higher quality managers to be able to perform. And also, you know, if growth does pick up again and that the inflation scare is only a temporary one, which is a prevailing view in the market as well. If it turns out to be the case, that we're still going to get a lot of that upside anyway.
Absolutely. The relationship between risk and reward outlines a growth over time, particularly for a growth investor, which we've spoken about a little bit. What about our defensive investors? We've seen some interest rate movements. Are we deviating away from fixed interest products into something that's a little bit more fluid and maybe variable? And how does that impact those investors?
Yeah, absolutely. So again, you know, your point is well made. So, you know, for the portfolios that have a higher exposure to fixed interest, we've made some changes, again, based on a more neutral stance, I guess, in the market, rather than sort of that the stance, you know, of low interest rates. So we've moved more from a fixed rate exposure to a floating rate exposure. So as interest rates increase, and obviously we don't know how far they're going to increase, as they increase, that the portfolios are going to get that exposure to that variable rate increases. And we've done that by shifting away from sort of more government bonds to, you know, high quality floating rate notes and those type of things that are exposed to high quality corporates like the Australian banks and, you know, sort of the larger companies within the Australian and international markets.
Great. Just wondering, can you give us an outline of some of the investment managers we've actually incorporated within the portfolio, but also the impact of the Aussie dollar in our decision making?
Yeah. So again, the Aussie dollar created a fair bit of debate within the investment committee, didn't it? And you know, the recommendation from the asset consultant was to remove the hedging from sort of 50% hedging in the international part of the portfolio to 30%, which the reasoning was that, you know, over the next 6 to 9 months, that the expectation is that the US are going to raise interest rates harder and faster than they are in Australia, and that interest rate differential will cause the Aussie dollar to reduce. I suppose, you know, in line with that, there's also that we've seen in China the lockdowns and sort of the potential impacts on those. So there's a bit of taken again a little bit of a more cautious stance around the Australian dollar. And then, you know, the investment managers within the portfolio, largely we've reduced, as I say, sort of that exposure to the growth managers and appointed them to managers, as I say, with that sort of more neutral stance, which are going to benefit regardless of the market conditions and are going to be able to deliver, you know, really solid returns for our investors.
Great. Over the last 2 years, we've seen quite a large rise across markets, but also a bit of a sell-off at the commencement of this year. Can you comment about the outlook going forward? So what do we expect going forward, Mark?
Yeah, so it's obviously a really difficult time to be making brave statements about what's going to happen in markets. Obviously, we haven't seen anything like this for a long time, if ever. Obviously, the massive stimulus that came through, as you pointed out, pushed markets higher because governments were spending a lot of money and propping up the economy, and people were expecting low interest rates for a long period of time. That expectation has changed. And the real situation in the market, I guess, at the moment is to understand whether that inflation is temporary, as in 2 to 3 year type temporary, or, you know, is going to be long term and we're going to start to see inflation due to wages, and wages inflation is the biggest driver of inflation. And so if that sort of comes through, markets have changed long term. So there is that real big shift, I guess, also from 30 years of falling interest rates to potentially a new era where interest rates are going to be rising, you know, certainly over the longer term. So, you know, it's really difficult to make a brave decision, and that's really reflected in what we've done within the portfolio, certainly for the next 6 to 9 months, is to be a little bit more cautious on it, as I say, tap the brakes a little bit, bring the portfolio back into a situation where if interest rates do increase, we're not going to be penalised severely. Obviously, that's the change within the fixed interest and also reducing those growth managers. But also, if it turns out that it's temporary and that inflation proves to start to be coming down and the expectations start to be coming down, we're still going to benefit from having exposure to growth assets, obviously within the portfolio, and obviously infrastructure and private equity as well.
Excellent. Mark, can I just ask you to talk about, once we make a decision within the investment committee, how is it applied across the MDA portfolios and how quickly is it applied across the MDA portfolios? Yeah.
So we met on Friday and we had a robust sort of 2.5 hour meeting, I think, in the end, which was probably a little bit of a record. But there's obviously massive changes as we've talked about, and debating those and discussing those. So once we agreed on those changes, we implemented them on Monday effectively, which takes a few days to flow through to the portfolio. So we've got our MDA portfolio provider who goes through the portfolio and works out what changes need to be made and the number of investments that need to be changed and the units that need to be changed, and then they send those through to the platform who will enact them. And so it probably takes 3 or 4 days for those changes to be reflected in client portfolios, which again is obviously a fantastic thing to be able to change relatively quickly. And yeah,
it's very efficient. Thank you, Mark. I appreciate your update. Great.
It's good to be doing it with you too, David. I appreciate your time here.
Pleasure. The investment committee meets on a monthly basis. The purpose of the group is to actually do a bit of a deep dive across our investors' money and determine, is it best managed the way it is, or do we apply some changes? We do that regularly. The group incorporates 4 professional practitioners from within the Hopkins Group, but also external parties that are independent to us. But hopefully you find this information thoughtful and informative. If you have any questions, please contact myself and Mark.
Absolutely.
Or any other member within the Hopkins Group that you liaise with on a regular basis. Thank you for your time.
Thanks for watching.